Major funding for these broadcasts has been provided by grants from New York Community Bank, AmTrust Title Insurance Company, Perfect Building Maintenance, M&T Bank, Customers Bank, Marks Paneth LLP, Capital One Bank, Collins Building Services, Meridian Capital Group. Additional support has been provided by grants from AKA Hotel Residences Corman Communities, Ariel Property Advisors, Amarant Bank, Bank of America Merrill Lynch, Briarwood Organization, Chase Commercial Mortgage Lending, Chase Commercial Term Lending, Citizens Bank, Dime Community Bank, Douglaston Development Levine Builders, Flushing Bank, Friedman LLP, Handro Properties LLC, Handler Real Estate Organization, Hodges Ward Elliott INC, Investors Bank, James D. Kuhn Real Estate Institute at Syracuse University, John Casamatides Red Apple Group, Keysight Capital Partners, Matone Group, New Banks, Newmark Knight Frank, Ocean First Bank, Optimum Window Manufacturing Corp., People's United Bank, Rockefeller Group, Rosewood Realty Services, Stonehenge NYC, SVN CPEX Real Estate Services, Tierra CRG, the Meringer Family Foundation, and these friends.
Oh, Crystal Apple, are you bright or are you dull? I don't know, but maybe today these four young guys, all under 40, will provide their insight on their thoughts for what's going to take place in the real estate market today and in 2021. My guests today include Michael Torrici, who is the Vice President and a partner at Ariel Property Advisors, Daryl Handler, who's the Executive Vice President at Handler Real Estate Organization, Nadir Settles, who is the Managing Director, New York Regional Head Office for Real Estate Investment for Nuveen Real Estate. And last but not least, the money man, Phil Watkins, who's head of commercial real estate for Customers Bank. So, Michael, how's my Apple looking? Has it gotten better since September, or are we dull? Where do we stand?
Look, everything is, you got to put in perspective. Since September, we've seen a lot more listings coming to market, maybe not as many as usual, both because of the pandemic, but also because of the election. But I'd say even going back to June, we've been doing a lot of asset evaluations for clients, trying to help them figure out pricing and think of strategies towards the end of this year and into early next. Since August, we've taken on 20 new assignments, and we'll have, I think, a pretty busy run up to the end of the year, and then we're gearing up for a relatively busy 2020 as people that have put off selling decisions come around to possibly putting things on the market.
What's happening with regard to people who had 1031s that have to buy? Are you seeing 1031 buyers, or are they saying, we'll worry about it, or hopefully the tax laws will change to make it easier?
Well, I mean, 1031 buyers, there haven't been a whole lot of them in the New York area because transaction volume has been pretty low. Even before COVID, with the new rent regulations that were put into effect and with the anticipation of further rent regulations that were going to possibly hit the market in June of 19, the 1031 market's been pretty quiet. So hopefully we'll see some more trades, and that'll change in 2021 unless there's new tax laws that come out and change the rules of the game for everybody.
You bring up the rent regulations, and we have our lender over here, Phil Watkins. Phil, how do you've been active going back a number of years ago in the multifamily market, but with the rent regulations and with the information that the rents are down, incentives are up, how is the bank looking at the financing of the rent regulated apartments today?
Yeah, it's continued to be, as Michael said, there was really a challenge in that space, that predated COVID, as a change in the law. Now, I will tell you, customers in particular was not very active in the value add rent regulated space. We were typically lending on in-place cash flows for buildings. I think the part of that market that's obviously most disrupted was the folks that had value add business plans for those rent regulated buildings. And that's really, ground to a halt, although it really wasn't somewhere that we were actively lending on. And so what we're seeing in our portfolio right now, at least to date, is actually, it's holding up very well. And we're seeing actually strong collections, and because this is, sort of, necessity-based housing and lower vacancies than I think you saw, in some of those value add buildings that were struggling more.
Nadir, since you're the money man over there in the other way of buying properties, okay, where do you see, have there been more opportunities over the last month or two, like the property that SL Green put on the market, with FaceTime? Are you seeing more properties going on the market?
We're not. So it's still very little activity as it relates to the capital markets. Sellers don't want to sell for a discount. This is New York. Typically, if you can hold through a recession, values rebound, and we've seen that for 100 years, right? Since the last pandemic, you take it back to any sort of major recession, major correction, New York rebounds. And so sellers know that, and if they don't have to capitulate to liquidity needs, they'll just hold. And so we're seeing that sort of anemic capital markets because buyers want these huge discounts that sellers don't want to offer. As it relates to 410 10th, I think if you do come out with that kind of high quality asset, so it's high credit tenant, it's in a work, live, play, great submarket. So the momentum and the push to the west has been going on for several years. Well, that's attractive. And then you got an asset that is well buttoned up. So it's leased, it's a long wall, there's no CapEx that is needed. And that's going to command, premium pricing, which that asset has. We'll see what happens once that ultimately transacts. But I think that'll transact at a cap rate that is certainly sub 5, and we'll see where that ends up at. And it'll look like a pre-COVID kind of trade, but I don't think that's indicative of where the market is to go unless you're bringing out that kind of high quality.
In order for people to buy buildings, you have to be leasing the buildings, and that's Daryl's job. And Daryl, why don't you talk to me about this transaction that you started pre-COVID, and now it's being transacted still in COVID, but not pre-COVID.
Yeah, so it's actually pretty interesting. We recently, thankfully closed a deal down in Chelsea for about 60,000 square feet. But what made it pretty, I thought, was unique was before the deal it was a renewal, and we were going to be taking old office space that was chopped up into, private offices on each floor, very kind of traditional old world office space. And we were going to gut it, make open plans, and, renovate floor by floor. Once March came around, we totally audibled and went back to the old traditional way of, keeping the offices private, upgrading the spaces, but keeping the bones of the space. And I think that might be a great, sort of story for how, you can see things going forward with the way spaces are laid out, in New York City and other office markets.
But I think here's the big question on that. Was the rent the same pre-COVID as it is being signed today?
It is not. It is not. It is not. We were fortunate to. I was representing the tenants, so we were fortunate to be able to lower the rent a bit to make the deal, work in a post-pandemic world.
That relates to Nadir, okay, because Nuveen Real Estate happens to own some great buildings, but now you're trying to lease certain buildings, and you may be leasing the buildings at a certain rent, but the concessions are increasing. Where is the position of Nuveen today if someone is looking to rent space?
Listen, we're in the business of filling space. So first and foremost, we're going to try to work through what are sort of mutual economics that work for both, occupier and landlord. I think tenants have trepidation right now around signing longer term leases. So maybe mutual beneficial terms could be that we deliver the space as is, and so we're not giving free rent or any TIs, but that person could come in, sign a short-term lease, and that works for them. And we didn't spend extra money on concessions, and maybe we dropped face rent a little bit to reflect today's leasing environment. But the total NER has not been impacted. So that's what we're thinking. We're just thinking remain nimble. I mean, if somebody does want to sign a longer term lease, then we're happy to do that as well. And then sort of work in, longer term abatement and as well as the appropriate TIs. So I don't think there's one sort of fixed way to go about sort of tenant demand and whether it's long term or sort of short term, 1 to the next 3 years. It's just what you sort of package as a concession has to be sort of consistent and in line with the terms of that deal, so that landlord's not putting out a lot of money for a short-term lease.
You know, you bring up the subject of money, and I go back to Phil. So you said that you've been relatively quiet with the multifamily because you really weren't that much active. But I think the bank has taken a position with what we call note-on-note financing, which I'd like you to explain to my audience and to the members of the panel and what you're doing with that.
Sure, absolutely. You know, I think even leading out of the last recession, and also as a function of some of the changing regulatory environment, you've seen a shift in the financing sources especially for more opportunistic type projects. So that's higher lift bridge and value add projects, construction projects. And you've seen a decrease in the share of banks underwriting, banks originating some of those loans directly, and a bigger increase from some of the private lending markets. So that's the debt funds, some of the mortgage REITs, and other players. And those players still finance those whole loans. They may be offering slightly higher leverage, whole loan leverage, than a bank might, but they still look to leverage a senior piece of that, and that's where we come in. So we really are able to provide a loan to those private lenders who provide a whole loan package to the underlying borrower, and we really think it makes a win-win for everyone. It meets the return expectations of the debt funds. The developers then have the ability to have a one-stop shop. They're not looking to a bank and a mezzanine lender together. They have one lender, and we found it, to be a very, very effective product in the market right now.
But here's the question: what type of loans are these for? Are they for residential rental? Are they for condos? Are they for industrial properties?
I will say even pre-pandemic, retail and hospitality were just not focus areas for us. Our main focus areas, as you outlined, we're traditionally multifamily lenders. So we're, doing a lot of this financing in multifamily construction, some in New York, but also in other major markets across the country. We are actively looking at industrial as well. Obviously, it's, the asset class that has, not just survived the pandemic better than other asset classes, but you're actually seeing instances in which, they're having increases in demands and rental rates in the industrial asset class, driven by that, that shift to bigger e-commerce that I know we've talked about. So, I would say those are our two focus areas, and then we selectively look at some of the other asset classes like office if there's a compelling story. But I would say retail and hospitality remain, pretty limited looks from us, even in the best of circumstances.
You bring up industrial, and I'm going to pose this question to Michael, Darrow, and to Nadir on this. Because Nadir, I believe, has some industrial ownership of property. And Michael, you've had certain properties which have been industrial and have been converted to office. What's the status today of those properties? How are you seeing them work today?
There's two types of buyers that are really going after industrial right now. Last mile distribution is huge. The challenge with that is that you need big footprints or very specific building specs to accommodate something like that. And there's also a pretty decent demand for smaller properties that can service owner users that are still in business and still work in the trades or in construction, and their leases say coming up, and instead of renewing at a lease, they want to get a property around the city. There's not that many places where businesses like that can go for industrial. The city has effectively done away with a huge amount of industrial over the past couple decades. So the values of those properties for owner users are still holding pretty strong amidst everything else.
Nadir?
Yeah, I think that's right. I mean, industrial is the darling of real estate right now. And certainly last mile logistics is something that we would love to be able to procure at this moment. It's just tough from a pricing perspective to justify for us. But if we're able to extend our reach a little bit and maybe go into Jersey, maybe into the boroughs, into untapped area that maybe we can redevelop and go through the entitlement process and create the value. We're looking at those type of opportunities, but certainly industrial is a focus for us. And I think it only became more of a focus just through the pandemic, because everything now is done through e-commerce, or the majority of stuff is done through e-commerce. And, logistics and last mile, getting that stuff to consumers, the demand for that is getting shorter and shorter and shorter. And so the closest you can be in fill certainly is a great value proposition. So we'll continue to look, but it's not easy.
That I think that in 2021, 2022, something that's happened in other submarkets around the country where you have these large shopping centers that are no longer viable, being turned into last mile logistics. And I think there's definitely some shopping centers out there in the New York area and the 5 boroughs that may start to see those trends take hold in the next couple of years.
There's been a lot in the press talking about the conversions of hotel to office. Any thoughts about that, Darryl?
Yeah, I think, a lot of these hotels that were, conveniently located near, major transportation hubs that have been majorly affected by the pandemic and the lack of business and leisure travel, need to find out what the highest and best use is for these assets going forward. And, with office, and obviously it takes time to convert these assets from, one use to the next. Hopefully that happens in a timeline where this beats the vaccine and therapeutic timeline, where you could, have these, office buildings near Grand Central or Penn Station or Port Authority that can make sense as an office building for the next, several decades. So you're seeing a lot of that. You're seeing that. And to go back to the last mile question you had mentioned, I'm seeing a lot of my clients who were in that sort of, retail industrial space with an office need part of their requirement. They have an increasingly large need for industrial space, and they want to kind of combine their operations with office and just, back of the office and warehouse near and around the city, whether that's in Jersey, whether that's in the Bronx or Maspeth. So with that comes, higher asking rents and taking rents. And so we're working with a number of groups trying to figure out what the best, game plan is, going forward.
A couple of years ago, the biggest tenant in the city of New York was WeWork. So here's the question for everybody, especially the banker, the investor, Mr. Settles, and all of you on this type of situation. How do you look at the co-working space today? Phil, I'm going to hit you first as the lender, and then I'm going to ask Darryl what's happening in co-working, and I want to ask Nadir his thoughts on it.
Sure. So, I'd say we really don't have anything in our portfolio that has co-working in it. But I can tell you, obviously, as with our credit hat on, I think there's a renewed focus on, what really is the credit that you're underwriting there, which is really it's a sublease model, right? Renting long-term rents and hoping to re-rent it at shorter term pricing. And I think, one of the myths that I think got a bit dispelled was the ability for above market rents driven solely by that model. in those buildings. And I think you do have to look at what is that space worth, like any other tenant that you might underwrite in an office building. If that tenant goes out, what is that space releasable at? Because, you know, while WeWork did have trouble, it's not a new model. You know, there were existing co-working
I mean,
companies.
Regis has been around for years, and so.
Yeah, exactly. So I think it's not that you can't underwrite that. I think what will go away is the concept of underwriting that premium rent for that space, just as a given, as part of that.
Daryl, do you see any of your clients asking to go to the co-working companies like WeWork or Regis and so on?
Yeah, so over the years, we put a number of clients in, you know, the various operators throughout the city, and they've been very happy there. It served a good purpose for them in the time of their, you know, tenancy. And, you know, during the last 6-7 months, we've actually seen a combination of either tenants leaving to go, you know, get more private space, as now privacy is a great amenity to tenants. But we also, it does give tenants this great flexibility in a time that's very uncertain as to where they can be in another year or so. So we have put a handful of tenants in the various operators here that want to sort of get their feet on the ground and figure out what, you know, who they're going to be, and take it from there. You know, it's going to be interesting to see how they reorganize the physical spaces and kind of, you know, gear toward the new trend of privacy, and how they reinvest in their own sort of facilities, and see how that works out for the market at large. But, you know, we definitely have seen, you know, demand from a leasing perspective from our tenants who want to be there.
Mike, how do you see when selling properties today, if the property has a co-working element?
I think to what Phil said, we need to see what we think the rents are today in the post-pandemic world with a discount. And with co-working, it's you know, it's based on the strength of the operator, but for the most part, we're looking at what the underlying rent could be, assuming that they can't hang with current conditions.
What's happening in the boroughs? Okay, is there activity? You know, this is a question for all. I know Nadir has investments in Long Island City, but how do people look at the boroughs today for investments? And as a bank, how do you look at it, Phil?
Interestingly, right now, you're actually seeing the boroughs, you know, across most metrics outperforming Manhattan, you know, which is obviously a bit counterintuitive, but I do think you're seeing stronger occupancy rates holding up in the boroughs. To the extent of the condo market, you're seeing better sales happening in the boroughs than in Manhattan. So, you know, I think right now in the short term, you actually are seeing a convergence between Manhattan and the boroughs by a number of those metrics. And I think that's in part driven by the, you know, for some of the folks that are, you know, staying in the city compared to some who have left, there's still that attribute to more space and a little bit less density in the boroughs. But I think, you know, I do think you'll see I do think you'll see a rebound. While I think there has been a secular tightening between many of the boroughs and Manhattan, you know, driven by users' demand for that. Over time, I do think it's probably compressing maybe a bit more right now than it might ultimately settle at.
Nadir, how do you see the boroughs? I mean, investing today, perhaps in Queens or the Bronx?
Yeah, I think that you know, the focus should be actually where on the recovery will be driven by. I think everything else sort of is an offshoot from Manhattan. If you can get an attractive basis in the center of gravity in Manhattan, why would you take the risk in sort of an exploratory market, even as maybe developed as one would say in Long Island City? I mean, I just walked Long Island City, and the boom that they thought was going to happen, half those buildings are either, you know, sub 80% occupied, which they consider healthy, or vacant. And these are brand new redeveloped buildings by some of the biggest institutional landlords that betted big on Long Island City to come. And then you look at that and with the proximity, with it being sort of, you know, spitting distance from Manhattan with the two subway rides, it seemed like a great bet when Manhattan prices and per square foot pricing. So leasing and per square foot pricing was going up so much. you can get great back office space with close proximity for connectivity to all the employees at a fraction of the cost. Now pricing is actually recalibrating in Manhattan is really cheap right now. So if I was to sign a lease, like you're seeing right now, right? You're not seeing Amazon, you're not seeing TikTok, AIG, Facebook go to any of the boroughs to sign these leases. They're striking leases right now in Manhattan because they're getting great economic incentive to do so, and where they know that it's going to recover first. And 3 years out from now, those leases will not be available as we recover and the vaccine and New York gets back to being Manhattan. That just won't happen. Then as Manhattan starts to fill out, I think that's where, you know, all tides lift all boats, right? Rising tide lifts all boats. And so then you'll start to see again, people start to say, whoa, $100 in Manhattan again? Let me go consider Long Island City for 75. And it's the close proximity. And then it's all the stuff around Brooklyn. But we've never really seen those markets take off. Brooklyn, Manhattan, Long Island City. Certainly the Bronx is not even enough institutional build. I think that's more government. If you look kind of southern Bronx, right there on Grand Concourse kind of thing, you can do something with the governments and a lot of the entities there that associate with the government. But, you know, proper office, where the growth is going to happen, it's going to happen back in Manhattan, and all the boroughs is going to kind of feed off of that. So at this point, I wouldn't be looking anywhere else in Manhattan, as that's where you got great value right now. Plenty of the stock needs to be transitioned anyway. The stock in Manhattan is something like 70 years old. So if we can do some of this stuff, like you said, around, is there an opportunity to convert some of these buildings from hotel to office? They're in great locations. Higher and better use may be office if you can get through, wrap your mind around the feasibility of doing that. That's going to be desirable as you enter into a post-COVID world where you got a new build, new technology, new systems. That's what's going to be important, and you probably can do that for a great value in Manhattan right now.
I think, you know, we brought up lots of interesting topics, and I will take my apple over here, and I'm going to see if the shininess is still there. It's getting shinier. I'm trying to get it shinier. And I think what comes out in summation is we need a vaccine. We need people to feel safe in the city. I think safety is very important. We need people to return, and 2021 should be a much better year. And I'd like to thank Michael, Nadir, Phil, and Daryl, and I'll see you next week. Thanks again.